Today's episode of the Watson Weekly Podcast is sponsored by Miracle, the catalyst of e-commerce. We all know that e-commerce is changing at breakneck speed, but if you're still playing by the rules of retail's past, you're leaving money on the table, and a lot of it. Miracle empowers 450 retailers to successfully flip the script and transform their businesses by creating a flywheel of AI-powered marketplace and retail media solutions. What's stopping you from joining this retail revolution? It's February 17th, 2025, and this is the Watson Weekly, your essential e-commerce digest. Today on our show, Shopify Q4 2024 earnings. The age of efficiency comes to Shopify. And it's not just you. The age of efficiency seems to be accelerating. Amazon Q4 earnings wins the Grammy for free cash flow. Amazon's ad engine getting hungry. Look out, Google Shopping. And finally, the Investor Minute, which contains 5 items this week from the world of venture capital, acquisitions, and IPOs. But first, in our shopping cart full of news, Shopify Q4 2024 earnings. The age of efficiency comes to Shopify. Shopify had a great earnings, but what's going on under the covers is more interesting. From a revenue point of view, Shopify grew 26% year over year to almost $9 billion. Subscription revenue grew 28%, and merchant services grew 25%. Subscriptions growing faster than merchant services is good news for Shopify cash flow. Merchant services is now 73% of Shopify revenue, slightly down from 75% last year. Still a big number. Gross margins are holding steady. Subscriptions are somewhat like 81% gross margin, and merchant solutions are about 39% gross margin, largely unchanged year over year. Shopify is not producing more gross profit on a percentage basis, yet free cash flow is exploding. How? The expense lines are where things actually get interesting. R&D reduced 21% year over year and is now only 15% of revenue. Wow. This comes from AI, removing management layers, and some layoffs. From a sales and marketing expense point of view, this only grew 13.9% year over year, on double that revenue growth. High word of mouth is likely a key component of this. And as far as general and administrative expenses, these are down 16.4% year over year. Support is also likely a key part of this. Free cash flow improved from $905 million to $1.6 billion, a 78% gain, mostly with expense management and the benefits of their marketing flywheel. In other words, great word of mouth, merchants people look to, etc. This is a good formula, and it stands for efficiency. But they can only do that coming from a large base of R&D as well as a pre-existing marketing flywheel and word of mouth. Other platforms must fight to be on an RFP evaluation list. Shopify is kind of beyond that, even in segments where their win rate is lower than their traditional B2C, SMB to mid-market core. Regarding enterprise, I see a lot of wins in progress, but it's also not a geyser. It's more like a trickle or maybe a faucet. Definitely they're making progress there, but not as fast as they might like, which is kind of my feeling, not necessarily theirs. Patience will still continue to be the watchword. My personal experience is, even if the client wants to move, it's a risk, and there are costs involved, and time. And it's not just the implementation costs. The time is almost as important. For an enterprise, it takes 6 to 9 months and over a dozen people if the brand is of any size. For an experimental brand, it could go much faster than that time though, and so the likelihood to move actually goes down as an inverse function to the size of the revenue being moved. My read generally is Magento and other end-of-life custom platforms are more likely to be moving because they have to. The Salesforce folks are still moving, but at a much slower pace, and it's more often a want-to move than a have-to move from the point of view of the CEO. This reduces the conversion rate slightly or delays the project altogether. The fact that Shopify is mostly in every deal allows this conversion rate not to matter so much. Harley is correct that businesses are coming to them as a rule over time rather than the other way around. The numbers reflect this, at least in direct-to-consumer. Industrial B2B is still nascent, and POS is kind of in between the two of these. but of the group, POS is the huge grower. Other tidbits, Shopify reported now that they are 12% of e-commerce market share. International has now spent the last 2 years above 30% growth, and Shop Pay is now 41% of the company's gross payments volume. All told, you see Shopify growing, but you also see them shrinking, expenses that is. Expect headcount to level off for the next 2 years from what I can see. Our second story. It's not just you, the age of efficiency is accelerating. Our last story talked about how the age of efficiency is coming for Shopify, but it's not just Shopify, it seems to be all of us. Recently, I've been speaking with over a dozen business owners across platforms, brands, retailers, and system integrators, and the consensus view seems to be simple. 2025 is already not quite the growth-oriented year we thought it could be. In 2024, Nick Kaplan and I talked about the dawn of the age of efficiency. You could see it everywhere, but I always pointed back to Walmart and Amazon leading the brigade, prioritizing margin dollar growth over revenue. Then, last year, a lot of growth taken up by Amazon, Walmart, Shein, and Temu. It leaves less for the rest of us. Well, the 2024 ship has come in and CFOs everywhere are asserting themselves even more. In short, the age of efficiency has kicked into overdrive. In many ways, I'm not surprised this is how early 2025 looks. Many companies miss 2024 growth numbers, which, unless they were aggressively cutting, means they miss profit forecasts by a wide margin too. I still see big projects starting, but fewer. And several of the re-platforms in flight seem more like a have to than a want to, which is tough news in the platform and system integrator world. And the ones that are starting are many times were supposed to start last year. For brand builders, this means it could also be a challenging year. CFOs are demanding a pound of flesh from every department. Brand-based advertising could start to sound like a hope and a prayer in the boardroom. After all, cuts are certain. Growth is uncertain. A new mindset is needed to focus those with the purse strings. Not one based on hope, but one based on the company's long-term strategic plan. First question, why does this brand exist and how will it exist without investment and then growth? Second question, what are our growth consumer segments? And third question, how do we prioritize our resources to serve them? Not that cuts won't happen. Of course they will. But if there's no growth story, then there's no brand story. Any monkey can cut costs indiscriminately. And if we let them, any monkey will. It's up to change agents to help make the case. Our third story. Amazon Q4 earnings win the Grammy for free cash flow. Many of us watched the Grammys in the last weeks, and if I had to award a Grammy for free cash flow this earnings season, it would go to Amazon. They are indeed not like the rest of us. From a numbers point of view, the Q4 North American segment revenue grew 10% year over year, but operating income was up 43%, globally up 60%. North American operating margin jumped to 8% in Q4, up from 6% last year on average. Q4 international operating income year over year went from a negative $400 million to a positive $1.3 billion. Q4 net income doubled. Let me repeat that, doubled. 2024 North American operating income was up 68% year over year, net sales being up 10%. International operating income went from negative $2.6 billion to positive $3.8 billion year over year. Net sales was up 8%. Amazon Web Services operating income was up 62%, while their sales were up 19%. Of the two big growth businesses we have here, AWS is now on a $115 billion annual run rate. The ads business is now a $69 billion annual run rate. Growing cash flow faster than revenue, and international is profitable for the first time ever. Other odds and ends. Online stores are up 8%. Physical stores are also up 8%. But at this point, should they sell this off? 8% off a small base is not good. Advertising is up 18%. And the company will spend over $100 billion on capital expenditures in 2025, mostly on AWS. I think something like 80% of that from my estimate, and the rest on logistics, technology, and other items. From a third party unit percentage, Amazon reported 62%, which is the highest ever. Overall, sales and marketing expenses went down by 1% year over year, yet sales went up by 8%. Who does that? Unit sales were up 11%, which is ahead of revenue growth. Amazon in Q4 redesigned their inventory network, which they described as a big architectural change. Of course, many sellers reported it was a disaster. But I think they will eventually fix this, maybe give them 2 quarters. Why the hell they redesigned this in Q4, I'll never understand. Amazon also reported on the call that they have over 1,000 generative AI applications they've either built or in the process of building. Overall, Financial Times didn't love the guidance reduced because of AWS server useful life decreasing, currency headwinds, and they also don't love CapEx so much. But still, there's a lot to like here, and 9 to 10% growth is a good baseline for the leader in e-commerce. And our last story, Amazon ad engine getting hungry. Look out, Google Shopping. Will Amazon add a comparison shopping engine on top of its marketplace results? We may soon find out. This week, Amazon made an announcement that it was starting to experiment in its mobile app to send users off Amazon. Seems crazy, right? What about all the money Amazon spends to get users in the app? Well, let's be clear about the backdrop. First, Google continues to be under threat from AI, particularly ChatGPT and others. So we are in a particularly turbulent period of disruption that a leading edge of consumers are working through new behaviors, which over the next 10 plus years will ripple through the larger population. 2, Amazon's own AI ambitions need more user intent data. A lot of that data is going to Google and ChatGPT today. Amazon is on the outside looking in. 3, Amazon needs more ad inventory. Prime Video and live sports have been huge unlocks for Amazon, and video ads are getting much smarter and more interactive. But online, people go to Amazon to shop for things with a guarantee to shop quickly, not to find any product across the world. Above the fold, most Amazon searches are 60% or more populated with ads. There's only so much more to add. Yeah, I went there. There are more search terms, which then create more ad inventory. Google has been the best of this for over a generation now. So what is Amazon's experiment? Amazon says, we'll show select products in our search results even if we don't sell them in our store, and link to the brand's website to make it easy for consumers to purchase them there. Notably, the quote is from Amazon's VP of Search and Conversational Shopping. Amazon recognizes that consumer purchase experiences can increasingly become a conversation, and the destination inventory may not be in an Amazon-affiliated warehouse. How does Amazon get information from a brand to show in its results at all? Right now, you have to request to get into the experiments via an email address. And soon, you may see Amazon become more like a comparison shopping engine, perhaps the engine that Google Shopping could have been if Google knew what it was doing. The fact that the experience is in an Amazon mobile app and not the general website means that Amazon could also have a pretty good idea where you are, which could increase the localized experience. The fact that a lot of the messaging around the announcement is for brands and doesn't mention sellers gives you some idea where their priorities lie. In other words, I expect this could be tied to brand registry even. More information to display means users can ask Amazon more questions and get better answers. It also ultimately gives Amazon more ad surface to display. Amazon seems to be, from my point of view, targeting Google's second search behavior, which is also common. After Amazon, Google Shopping is many times my own second search. And Amazon is asking a simple question: why not us? Now, we may soon know the answer. It's that time, friends, for our Investor Minute. We have 5 items on the menu today. First, sporting goods maker Vista Outdoor gets $2.9 billion takeover offer. Outdoor recreation platform Vista Outdoor received a $2.9 billion takeover offer from PE firm MNC Capital Partners at $35 per share, which it reviewed and ultimately turned down. Vista Outdoor would agree to a deal in which it divided itself in two, selling its ammunition business, the Kinetic Group, to Czechoslovak Group for $2.2 billion. Its performance gear brand, Revitalist, was sold to Strategic Value Partners for a reported $1.1 billion. Second, the race to build a generative AI platform for fashion design. Raspberry AI raised $4.5 million in seed funding and announced $24 million in Series A funding. The funding will be invested in the company's technology and hiring talent. Why is this so important? The fashion design and creative sector is amid startup competition, and they want to offer generative AI solutions to accelerate the design of goods. This is another sector in which technology will accelerate the design of multiple versions of a single item. Third, Groupe Dynamite launches Canadian IPO. Canadian women's clothing retailer Groupe Dynamite closed its initial public offering and raised Canadian dollars worth $300 million. Groupe Dynamite had a revenue of $888 million Canadian and net income of $128 million for the year ended August 3, 2024, and a total debt of $469 million. A dual-brand business with retail locations in Canada and the U.S. that was once family-owned that evolved and offers profitable e-commerce is not often seen. Fourth, Walmart completes $2.3 billion acquisition of Vizio. Walmart announced the closure of its $2.3 billion Vizio acquisition. The acquisition of Vizio and its SmartCast operating system allows Walmart to offer its consumers new purchase journeys. It also enables Walmart to offer brands an opportunity to reach consumers and provides further real estate that can offer via Walmart Connect, its omnichannel retail media property. And finally, Vuma raises $16 million in seed and Series A funding. Freight booking automation platform Vuma has raised $16 million in seed and Series A funding that will be invested in hiring talent, go-to-market, and customer success. As part of the funding announcement, the company unveiled its AI agents platform that will enable the automation of processes and the use of AI agents' voices to automate monotonous tasks without needing a human. The freight and carrier broker sector will likely see a significant degree of automation via AI in the future. That's all for this week. Till next time, Watsonians. Hi, I'm Rick Watson, CEO and founder of RMW Commerce Consulting and host of the Watson Weekly podcast, your essential e-commerce digest. Our production partner for the series is Citizen Racecar. The show is produced by Jose Baez. To hear new episodes of the show every Monday morning, subscribe now at rmwcommerce.com/Watson Weekly and wherever you get your podcasts.